Part 1. Introduction. Before investing a single dollar, every investor must answer two important questions. 1. What is my time horizon? 2. What is my risk tolerance? These two factors will shape how you invest, what assets you choose, and whether you'll sleep peacefully at night or worry endlessly about your portfolio. Part 2. Time horizon. Definition. Your time horizon is the amount of time you can keep your money invested before you need to spend it. Short-term horizon, 1 to 3 years money you'll need soon, like a house down payment or tuition fees. It cannot afford to lose value. Medium-term horizon, 4 to 10 years, saving for goals like a child's education. Some growth is possible, but safety matters. Long-term horizon, 10 plus years retirement or legacy wealth. Here, you can take more risk because time gives the market room to recover. Storytelling example. Think of time horizon like a road trip. If you're driving across the country, a few traffic jams don't matter. You'll still reach your destination. That's like investing for retirement. Short-term bumps don't derail the long-term journey. But if you're just driving across town for an important meeting, even a short delay could make you late. That is short-term horizon, when your money can't afford detours or setbacks. Lesson. The longer your time horizon, the more risk you can usually afford to take. Part 3. Risk tolerance. Definition. Risk tolerance is your personal ability, both financially and emotionally, to handle the ups and downs of the market. Low risk tolerance. Dislike losses. Prefer stability. Best with safer investments like bonds and fixed income. Moderate risk tolerance. Can accept short-term declines in exchange for steady long-term growth. High risk tolerance. Comfortable with volatility. Willing to ride out big swings for higher returns. Storytelling example. Imagine 3 friends investing $10,000 each. When the market drops 20%, Sarah panics and sells everything. David feels uneasy, but he waits it out. Linda gets excited. She sees stocks as on sale and buys more. Same market, 3 different reactions. That's risk tolerance in action. Lesson. Risk tolerance is deeply personal. It's about how much loss you can see on your screen without losing sleep. Part 4. When time horizon and risk tolerance meet. Here's where investing gets real. It's not enough to know your time horizon or your risk tolerance. They must align. Example scenarios. James, 25 years old, he's saving for retirement in 40 years. Long time horizon plus high risk tolerance equals a growth-heavy portfolio, stocks, equity funds. Michael, 45 years old, wants to buy a house in 3 years. Short horizon plus, even if he has high risk tolerance, equals he must play safe, bonds, savings, because he cannot risk losing his house fund. Maria, 60 years old, retiring in 5 years. Short horizon plus low tolerance equals she needs stability and income-producing investments. Lesson. Always invest based on both your goals timeline and your comfort with risk. Part 5. Age and goals. Your stage of life influences both your horizon and tolerance. Young investors, long horizons, can recover from market dips, so they usually invest in growth-oriented assets. Middle-aged investors, balancing retirement, mortgage, and children's education. Portfolios are often balanced, growth with some stability. Retirees, protecting wealth and drawing income. Focuses on stability and preservation, not aggressive growth. Storytelling example. Think of investing like running a race. In your 20s, you're at the start line. You can pace yourself, take risks, and recover. In your 40s, you're mid-race. You need strategy, balancing speed and endurance. In your 60s, you're close to the finish line. You can't risk injury, so you play it safe to reach the goal. Part 6. Practical steps. 1. Write down your financial goals. 2. Determine how long you have to reach each goal, time horizon. 3. Be honest about your comfort with market swings, risk tolerance. 4. Match your investments accordingly. 5. Revisit regularly. Both your life and the market will change. Part 7. Conclusion and call to action. Successful investing is not about chasing the highest returns. It's about creating a portfolio that matches your time horizon when you'll need the money, fits your risk tolerance, what you can emotionally handle. When both align, you'll not only grow your wealth, but also enjoy peace of mind. Before you invest a single dollar, ask yourself 2 questions. When will I need this money? How much risk can I handle without losing sleep? Answer those honestly, and you'll already be on your way to becoming a smart, confident investor. If you gain value from this video, don't forget to click the thumbs button, subscribe, and turn on the notification button for more videos like this. Thanks for watching. Don't forget to like, share, and subscribe.